Hey there, it's Mike Langford. Welcome to another episode of the Augmented Advisor podcast brought to you by Blue Leaf. On this episode of the show, John Prendergast and I are joined by John Merante, the senior economist from SkyView Partners. And we're going to be exploring the economic impacts of the COVID-19 pandemic, both to date and going forward. This is a really important podcast episode because your clients are likely having a lot of the same questions rattle around in their head that we posed to John Merante. For instance, if the economy took such a big hit due to COVID-19, why are we seeing skyrocketing home prices and high inflation numbers? Are these long-term structural changes that will affect your clients' portfolios? Or are these things that are likely to revert back to normal after the pandemic's gone? And of course, my favorite question, what does an economist look forward to studying about this time in history once the pandemic is officially over? It's all good stuff. You're really going to love this episode of the show. Before we get started, make sure you take a moment to subscribe to the podcast on Apple Podcasts, Spotify, Google, Amazon, YouTube, or wherever you like to get your podcast jam on it. If you have a question or a suggestion for a topic or a guest for the show, please feel free to reach out by shooting us an email, podcast@blueleaf.com, or swing by the website or hit us up on the socials. Blue Leaf, John, and myself, we're all active on LinkedIn and Twitter and pretty much everywhere else, and we're really easy to find. Okay, let's get to our conversation with John Merante. Well, two Johns on the same screen. I don't know what to do with myself. John Merante, Happy New Year. John Prendergast, Happy New Year. Wonderful to see both of you today.
Brother.
Yeah, this is fantastic. So, John Merante, we're so excited to have you on because you are, number one, the most exciting and engaging economist I've ever met in my life. And I've had the good fortune of meeting lots of economists. Not all of them are very engaging. So when John and I were talking about, hey, we should probably have somebody on who can...
You are the largest giant shrimp we have.
Exactly.
You ever see tiger prawns? They're pretty big.
They are pretty good. Gulf shrimp, baby, are the way to go. Exactly. By the way, before we get into now that you brought it up, quick aside on the shrimp story, you guys will appreciate this. So I went to Savannah once for a speaking gig, and I get in late. I'm kind of hungry, and I'm like, well, I'll go down to the hotel bar, have a drink, and see if they have any food on the menu. So I go down, and they say, Gulf shrimp, cocktail, $19 or something like that for a bucket and sauce or whatever. I'm like, okay, so I'm thinking it's like this little ornamental cute bucket. I am not exaggerating when I tell you it was a legitimate bucket, like this big around, like a full couple of pounds of shrimp, and it was nuts. I'm like, this is like Homer Simpson style. Like, I haven't had all the shrimp I could eat, and I ate a few of them. I'm going. I'm like, I just can't do this. So finally, I'm like, I'm stuffed, and I look up, and there's a couple of dudes at the bar who've clearly been golfing all day, and they're sunburnt, and they're having a grand old time. So I go up to them, hey, this is
always
gonna be
a
weird.
Couple of dudes.
Yeah. I'm like, would you guys like some shrimp? I ordered this stupid thing. I have no idea how I can't finish it. They looked at me like I was handing them a bucket of gold, like I was a leprechaun or something like that. They're like, oh, this is going to be good. Just annihilated it. Anyway, from our shrimp, best looking shrimp. So Happy New Year. Getting back to why we wanted you on the show. We want to talk about the pandemic, its impact and so forth. And we thought we'd reach out to you and have you on. So again, welcome to the Augmented Advisor podcast. We're thrilled to have you.
Thank you.
So the pandemic, I mean, it's on everybody's mind. It's what all the cool kids are talking about. But I think, obviously took all of us by surprise back in 2019 and 2020. And in the early days, we all saw things that we sort of expected when you can't go to work and, you can't go out to eat. And there's a lot of economic fallout, right? Stock markets took a hit, businesses closed, people are out of work. And then somewhere along the way, things turned. And I think to non-economists, you sort of scratch your head. The markets rallied, home prices skyrocketed. I mean, thank you. I'm happy about that. Labor shortages, not so much. So for anyone, but especially for us in the financial space, for financial advisors, it's a bit head scratching, right? So can you talk a little bit about, the weird elixir that led to these counterintuitive swings during the pandemic?
Okay, is that for me?
Yeah, that's for you.
Okay.
Let's go.
Well, it's certainly not for Mike.
Yeah,
Yeah.
I'll just throw out some random opinions that actually, yeah, nobody does.
Okay. Basically, it comes down to the government finally figuring out that you need to use both monetary and fiscal policy. If you go back to 2020 and what was that like? March, April, I think, in 2020, we lost 20 million jobs. First thing the Fed did was start pouring money in through large asset purchases, quantitative easing. And then that was followed up by a large, and some people say stimulus. Mike knows I refer to these things as disaster relief, because when you lose 20 million jobs, that is a disaster. And so you had a very large fiscal inflows into the economy. You remember back with PPP and all those acronyms then. I was thinking, oh
Sure.
wow, we're going to get a new deal. But no, so you had money going directly to people. I mean, you had checks sent out, you had extended unemployment, you had money going to states, and definitely going to industries that were affected by it. So what you wound up doing is by using monetary policy to maintain financial stability, you avoid a financial crisis, which could easily happen. And then you also made people whole because they were hurt through no fault of their own. All of a sudden, we get I mean, think of it as a tidal wave sweeping across the country, really. And, you didn't have the type of disaster that you had with the tornadoes in Kentucky, where houses are destroyed and everything, but jobs were destroyed. Downtowns were effectively shut down. So you had to turn that around somehow, because if you didn't, you would have wound up in a situation where you would have gotten what started off as a supply shock and continued to be a supply shock would have morphed into a demand shock because people just didn't have money coming in. And on top of that, you probably would have seen a wave of bankruptcies and foreclosures because no one had money to spend. You don't have a job. I don't know what unemployment insurance is like in Texas, but let's say Florida is not as generous as Massachusetts. And, you're not going to make it last for very long. And so you had to get money into the hands of people if you're going to have any hope of keeping the economy whole. I mean, in fairness to Steve Mnuchin, he did a surprisingly good job there. It was an abandonment of the more classical Republican approach, but it was what was necessary. You had fiscal policy and monetary policy working together. And we really only saw that once during the Great Recession, following the financial crisis back in 2010, and then that went away. What then happened, and where you really got the extra kick out of it, is you come into 2021. The Fed is still pursuing easy monetary policy, and the government comes in with another large disaster relief package. Now, what's interesting about this one, though, is which was 1.7 trillion. No, 1.9 trillion. I'm sorry, 1.9 trillion, and that was money that went out right away. And if we get around to Build Back Better later, we can talk about why that's important. But what happened there was you didn't get much more stimulus out of it, largely because much of it wasn't spent. There was a lot of money that went to state and local governments, and they largely banked it. They didn't spend most of it. It's there. It's going to get spent, but by and large, it wasn't spent yet. Then you had the checks that went out to everybody, and you had enhanced unemployment. Well, people did spend the enhanced unemployment. You saw demand go up, most of it for durable goods, and that gets into the inflation discussion a little bit. But what you also saw was savings rate go way up. Because what people wound up doing is they switched how they were spending money. You couldn't go to the movies any longer. You couldn't go out to dinner. You couldn't go clubbing. You couldn't, basically, if you had to be in public, you couldn't be there. So what do? Well, I can't go to the gym, so I'm going to order a Peloton. And 6 months later, I'll sell it on Craigslist. But so you had a lot of demand coming back in, but it was all towards a different segment of the economy. Basically, the composition of GDP switched somewhat. You moved away from overwhelmingly services to a fair sprinkling of goods. So people were buying more goods using fewer services.
You know, what's amazing as an armchair economist is it sort of paints a picture of Friedman and Keynes walking arm in arm down the lane, which is a really odd picture, right? Those those are at odds, right? And have been typically at odds. Pandemic gave us a really interesting laboratory in which we ran those ideas side by side as complementary, and it worked. I mean, to me, that's amazing.
Well, everyone knows Keynes because of government picking up the shortfall in aggregate demand, come in with big programs, build dams, build roads, pay people to dig ditches and pay other people to fill the ditches up, whatever. But Keynes was a big monetary guy also, and he was very concerned with the financial system. So a lot of this really does all go back to the general theory of, but it was all lost along the way, and so you wound up. Very brief economic history here. You wound up in the 50s and 60s, where what I guess people nowadays would call vulgar Keynesian just talked about using government spending as a tool to smooth out and fine-tune the economy. And that went on for a while until you had an unfortunate confluence of events, being largely the Great Society, the Vietnam War, and Arthur Burns in the Federal Reserve. And what happened then was you had large government expenditures with an incredibly dovish Fed, largely because Nixon felt that he lost the 60 election because Eckert had tightened monetary policy before going into the election, and he didn't want to see anything like that happen again in 72. And so you had very loose fiscal monetary policy from Burns, and that's where you got the beginning of the great inflation during the 70s. So it can work the wrong way too. If you're not doing it because the economy really needs something, but you're doing it because you got yourself involved in a quagmire in Southeast Asia, and you're running monetary policy to get the president reelected.
Yeah. It's interesting. It always reminds me, I watch a lot of sports, and we follow sports very closely, particularly basketball. We think about the teams and how they're constructed and so forth. And this is very similar to like a general manager who knows like, hey, by the time this becomes a problem, all these trades and things that I've done, the way I've loaded up my team and the way I've set up my salary cap, and I'm going to be in the luxury tax. By the time this becomes a really big problem, either we'll have won a championship or I'm going to get fired anyway. So I might not be here. So I'll let it be somebody else's problem. This is why, and by the way, this is part of the reason why, we have some separation between the Federal Reserve and the political bodies of our government. I want to dive into the inflation thing a little bit more, because you brought it up, and I think one of the overall goals for this particular episode of the show is to help translate some things for the financial advisor, so the financial advisor can either better serve their clients or at least better articulate what's happening for the client and what we can expect. Because we'll just be honest, most financial advisors didn't study economics in college. You'd be surprised at how many didn't study finance in college, right? They became a financial advisor after they were out of college and they learned what they needed to learn, but they did not spend a lot of time understanding how the economy actually works. And so therefore sometimes they're like all of us running around with a little bit of misinformation from a nugget they picked up in a newscast or whatever. So I thought maybe we could dive into some things here because one of the things that's been prior to Omicron, like getting in the news and being the sole focus for most people, is inflation going up. Back in November, the CPI came out and it was like twice as high, more than twice as high as the standard that most financial advisors use in the financial plans for their clients, right? Most financial advisors have an assumption that inflation will be about 3% on average because it kind of has been, right? That we can expect 3%. 6.8% in November of 2020 is what it was, the annualized inflation rate. So maybe we can spend a little bit of time here diving into like, what are the core drivers there? And should advisors be alarmed? Is this something that's going to negatively impact their clients long-term, or is this maybe a blip? What are your thoughts there?
Okay. You want to take it, John? Um, no, only kidding. Only kidding.
Well, in my great experience as an economist, oh yeah, I don't have any.
No, it's the drivers. I mean, what's interesting, as I said, you saw the switch in the composition of GDP away from services towards goods. You also saw that in the inflation numbers. If you look at the previous, let's go back pre-March 2020. For the prior 20, 25 years, every year in, year out, you saw either disinflation or outright deflation in good prices. They were dropping. And services, particularly education, medical, and shelter, were driving the increases, whatever increase we saw in inflation. And don't forget that, basically prior to this year, the Fed hadn't reached its 2% target on the personal consumption expenditures index for something like 15 years. So we got used to very low inflation, part of that being driven down by improvements in manufacturing, let's say. Basically, outsourcing and automation just kept driving prices down. Then all of a sudden, China shut down. They were literally closing entire cities. In some cases, they were walling people into their apartment buildings. They were not allowed to get out. So the factories didn't work any longer. Well, if there's a hiccup in China, well, there's going to be a lot worse happening in the rest of the supply chain. Thailand, Malaysia, Vietnam, and and so you have a situation there where um, we couldn't get the goods we needed. So the main good we couldn't get that we needed became semiconductors. And if you look around your kitchen, there's a friggin' semiconductor and everything in there. And there are probably more semiconductors than anything else in a car nowadays. So you had a sudden problem with producing goods, and those prices started going up. Then you had, in addition to that, well, I remember not too long ago, pre-Delta, everybody thought things were great. We put COVID behind us. We're opening up everything. New York opened up, Boston opened up. Austin and Miami never closed, so they were coming back. But what you did find was that even they lost workers because, if you're making minimum wage, is it worth getting COVID? Probably not. So people left their jobs for that reason. Well, now you started opening up again. There was more demand for some services. So you started seeing prices go up for other things like airplane tickets. You used to be able to fly to Miami for $69 because from New York because nobody wanted to get on a plane. Well, that went right back to where it was. Hotel rooms went back up. Rent-a-cars went back up. And you saw all of this going up in CPI, just as you saw durable good prices going up. And that's what was driving the inflation that we've seen. Now the question is, and we got the diktat last month from Jay Powell, we're not to use the word transitory any longer. And I always tried to avoid that word because I used to make fun of people in 4 or 5 years ago when we were having very low inflation, talking about how all the low inflation was transitory. And I felt kind of, as somebody who made fun of people saying low inflation was transitory, I didn't feel comfortable saying high inflation was transitory. But what you have to assume, if you believe that it is a permanent change, that we're going to go forward and the Fed somehow lost control of inflation and we're going to get into a wage price spiral and all that, what you have to assume is the underlying fundamentals, which are largely based on demographics, on an aging population, on a population where you have very concentrated wealth. These are just facts. I'm not saying it's good, bad, or indifferent or anything. But when you get concentrated wealth and an aging population, you usually wind up with a savings gap. You're saving far more than you need, and that's what's happening now. Somebody who's worth $300 billion like Elon Musk, how much more can he spend on sending ships to the moon? But the point is that you have powerful underlying fundamental forces that kept inflation down for years. And it's hard to see why that would have changed. If anything, it probably accelerated it because you now have even more people retiring. The demographics have not changed for the better. They basically haven't changed. So unless you think that those demographic forces really didn't account for the low inflation that we were seeing before, then if you think we're going to start seeing continued high inflation, you got to think that the fundamentals today are different.
So, I had a college professor once describe inflation as a phenomenon where you have too much money chasing too few goods or too few services, right? So there's, more people want the thing. So it's a supply and demand thing, right? There's lots of monetary demand out there. People have money in their pockets. They want to buy the thing. There's not as many of those things. And I've observationally seen a couple of these. You mentioned one with a chip shortage. We had to buy my son a car. He got his license during the pandemic. And used car prices skyrocketed because there weren't as many and there weren't as many new cars. So I ended up paying, I paid like $4,000 more for this car that I bought him than I should have. You mentioned the rental car thing. That's a really interesting one to me. Is we flew up to Boston for a funeral last year, and it was the great rental car apocalypse. Because companies like Hertz almost went out of business. They sold their fleets because nobody was renting cars. And now as people started trickling back into the travel sphere, guess what? Not that many rental cars available. So if you want to rent one, you're going to pay more and it's going to be hard to get one, right? And we showed up at Logan Airport and literally there was a line. I had a car reserved, no cars. We had to wait for the car. You know what I mean? So this has just been an absolutely fascinating time just to see this in action. This is like just wacky, this inflation.
Yeah.
Yeah, but the core question is still this issue of, is the changes that are driving this structural or not? And, John, I think your point is it's hard to see that it's structural, right? Transitory makes it sound like it's blip, and these kind of disruptions tend, there's never been a disruption quite like this, but anything you could come up with as a corollary tend to take several years to work themselves out, right? It just takes a while. So the interesting thing to me that you said, again, armchair economist, was how much of the components of GDP may have been actually deflationary, which, for maybe the armchair and not so armchair economists, that could be really scary to have a deflationary spiral in the economy. Can you talk a little bit about if there's a real danger there, or if it is more likely that because of the services mix, it's not likely to sort of swamp the rest of the economy and actually become
Yeah, I mean,
deflationary.
we didn't see that develop during the financial crisis. And if there was a time when I mean, I was expecting something like that. But if there was a time that you should have seen it, it would have been then. Also, don't forget, I mean, when oh God, we're going to have to get into hedonic improvements. Um, every
I want
infl
to hear about this. This is
every
great.
inflation hawks.
Before you go there, John, before you go there, we will promise to our advisors to have an economics dictionary associated with
That's a good idea.
this episode, because we're
Yeah.
going for it here. So
Sorry. Well, basically,
All
what it
right.
comes down to is the price of a TV really hasn't changed all that much since we were buying cathode ray tubes. Whatever was the top line television in 1989, what you paid for it then, you're pretty much paying that for the top line television today, except the top line television today is flat screen, much larger, is a smart TV, all the improvements, all the bells and whistles. So it's not that the prices literally came down, it's just products became so much better. And even in cars where prices have gone up, and you can see that prices have gone up, you now have rear view cameras. You have self-stopping cars so you don't plow into somebody walking in front of you. Yeah. So you keep getting these improvements. And in many cases, prices don't go up, or if they do go up, they really don't go up anywhere near to cover the improvement. And so how if you're trying to get a price gauge, I mean, you can't compare you know, a 2022 Audi SUV to, a Chrysler Voyager from 1983. It's just not the same, it's very, very different, and you have to make adjustments, and hence you get hedonic pricing. So, but it does weigh on, I mean, the simplest explanation of that is, what would you rather have? If you really think inflation is out of control, would you rather have $1,000 to use to buy whatever you want on Amazon today, or $1,000 to go through the Sears 1976 catalog?
By the way, I have an affection for the catalog back in the day.
Hey,
Maybe,
never mind the
Yeah.
buying power advantage that John just described.
that's right. That's awesome. That's
Yeah, we know the lingerie
It's funny,
section.
John.
Exactly.
Yeah, John, it's funny you said the Sears catalog. I could literally smell that. Like, I remember how it smelled. It was such a large part of our lives. You talked about earlier, we talked a little bit about savings rate and how, on the surface it might have seemed counterintuitive, but maybe really obvious. Can you talk about the ways in which the change in saving rate has sort of developed over the course of the pandemic, and sort of where we're at with that right now, and how you see that going forward?
Well, what was really interesting and what I think is really important is that for once everybody was saving. All across the income scale, people were saving. And that had a lot to do with the $1,500 check. It had a lot to do with enhanced unemployment. But also, what was very important was the broad-based, fully refundable child tax credit. You had a kid, you get a tax credit. Your taxes were zero, you still got a refundable credit. The government paid you the money out even if you didn't pay taxes. When they did that, poverty levels dropped by over 40%. So that freed up a lot of people to do things. And even on the lower income scale, maybe the money wasn't going into the bank, but the money was being used for something like paying down credit card debt, or getting the hell out from under payday debts, or finally getting that car repair that you've been putting off because you just didn't have the money. but most of it went for consumables at that level. Most of it went for food, better food, clothes, school supplies, all the things that you expect to spend when you have a kid. And people didn't necessarily have enough money before. So that's part of it. Part of it was simply that if you were somewhat better off, what were you going to spend the money on? Maybe you didn't want to get a Peloton, and instead you just didn't renew your gym membership because of COVID. So you saved money that way. You weren't going to movies. Netflix is a lot cheaper than the multiplex. So people were saving, almost had a forced savings because what were you going to spend it on?
And we felt it. Some of the things you're just describing, like, my family, we go out to eat fairly frequently. It's just kind of what we do. We'll, go out and grab a bite to eat or go to the movies, as you described. Well, suddenly that, for a family of four who does those types of things in any given month, that's $500-600 out of a month that wasn't being spent, right? And my wife and I both are, work from home, so we weren't worried about the commute and all that type of stuff. But it's like suddenly there was just money that wasn't going out the door anymore. So of course our savings rate went up.
And people who were commuting didn't have to put gas in the tank because they weren't commuting any longer. Mm-hmm. They didn't have to buy a Long Island Railroad monthly ticket. There was a lot of ways that people were saving. You were eating at home now instead of running down to the Dunkin' Donuts to get your breakfast donut. I mean, it's, there were lots of little things that day in, day out, you don't think about. And it causes people to save money. But a lot of it was also just a lot of money was flowing out and people just didn't have stuff to spend on. So the idea that people are just going to waste money if the government gives it to them, that just wasn't borne out by this experience. The people who largely spent it on real, true necessities.
Yeah.
And I mean, I don't know if everyone in the audience understands how the government figures out the savings rate, but basically savings is a remainder. They look at total income. They subtract total consumption, and what's ever left over is considered savings. Because you got two uses for your income, consumption and savings. So paying down credit cards is a savings. Paying off your mortgage is a savings. Even though nothing's going in your bank, you just increased your net worth by getting rid of some debt.
Yeah. Well, and that's a really interesting I'm glad you brought that up because you mentioned that you said you think everybody in the audience understands that. I don't think that's true. I think it's a really important point. Debt service is not consumption, right? So if you had $1,000 in credit card debt and you chose to use some of the money that came, whether it's a child tax credit or whatever, you chose to use some of that money to pay off your credit card, and you didn't consume that money, but so it wasn't captured in consumption, right? But it ended up as savings.
And for those of you who are alarmed and haven't thought all the way through this, that credit card spending was already counted as consumption previously, right? So it's the debt portion and paying that off that's savings. It's not spending on a credit card that's savings. Just want to clarify that for anybody who made that leap.
And the interest is obviously counted as income for the bank or the credit card company or whomever.
Yeah. So while we're kind of on the topic of debt, let's move into something you talked about earlier. Is that the disaster relief is not stimulus, right? That a lot of this stuff that we called stimulus, right? Checks going out to people. You articulated it differently, and I really loved it. It actually changed the way that I've thought about this. Not that I had a particularly strong, against or whatever. I just didn't think of it as disaster recovery, disaster relief funding. But what if you could walk us through that and why it was really a smart economic event to do this? We hinted at it a little bit before, but what are the objections that people bring to like more of this? Is sometimes it's like, well, I don't want to give people free money. There's some people who rage about that, but very often people are concerned with the national debt, right? They get very they hold it up as like, look at how much money the government owes, and your children and grandchildren are going to have to pay this off and this and that. So I wonder if we can kind of talk about it through that lens of like, hey, why this disaster relief was so important and why it was, a good use of the government or oh, wait, maybe it wasn't in your opinion, like why the use of federal funds, and likely from debt, to do this it was important in the impact of it.
Okay, well, think about, I was going to use the tornadoes again, but let's go further back. Let's go someplace nearer and dearer to my home. 2001, towers come down, over 2,000 people died. Massive dislocations throughout New York. And I don't remember how much money went out, and it didn't just all go to New York. I mean, I lost my office and my apartment in that attack, and I benefited from relief from, the government, from services like the Salvation Army, all the people who come in and do disaster relief. You lost 2,000 people. In the past 22, 23 months, we've lost over 800,000 Americans. These are people who some of them had jobs who died, and family lost income. People have funeral expenses. They have the grieving process. They don't know what they're going to go through. And, in a sense, 2001, 9/11 isn't a good example because that was an act of war. This was a true natural disaster. This wasn't, something we did to ourselves or those bad people over there did to us. This is no different except for the scale, in terms of the number of people dead, no different than a hurricane or a tornado or an earthquake is what nature did to us. And I think that it's important to try to keep that in mind when looking at this. It's not that these people are undeserving. They're unfortunate. They got sick. And in order to prevent more people from getting sick and more Americans dying, we had to take a lot of steps. Some people will disagree with those steps. I understand that. Some people will say, let her rip and we'll all get natural immunity. We still wound up with 800,000 dead people. We wound up, since the vaccine, I'm trying to think what the exact number is, but I think it's over 200,000 additional deaths since the vaccine. Don't quote me on that because I'm not sure of the exact number, but it's very large. Okay, and we know the vaccine works. We know even against Omicron, if you have 2 shots and the booster, the chances of you getting very sick, as long as you're not immunosuppressant, is very low. So, why are we allowing this to happen when we could stop it? And until we stop it, there's going to be ripple effects through the economy. You saw it with 20 million people losing their job. Don't we go and give extended unemployment insurance when a hurricane hits the Gulf? Pretty sure the government does that. Why shouldn't we do that when a pandemic hits and 20 million people in a 2-month period lose work? You knock 20 million people out of the labor force, you're not going to have much demand out there. So instead of just having the supply shock that we had, because all of a sudden offices weren't open, factories weren't open, ships weren't sailing, you now have a demand shock on top of it. And that then ripples through in terms of credit with bankruptcies.
Oop, lost you there for a second, John. Oop,
Am I still here?
Up.
Can you hear me? Okay.
Mm-hmm.
Okay.
You don't know who's a solvent borrower. So credit seizes up just like it did in the financial crisis. If I'm a bank and I don't know when you're going to be able to get semiconductors, GM, so that you can reopen your supply lines and start putting cars on the road again, how much money am I going to loan you? How do I figure out that credit risk? And if we don't do something to keep the workers employed, Where are you going to get your workers from when you do finally reopen?
Mhm. So in a lot of ways, John, that feels like an argument that it's disaster relief precisely because the events dislocated the normal functioning of the economy, and the money and the programs were intended to restore at least partly the normal function of the economy, or bridge until we could get back to something more normal. It is not sort of it's like the difference between peacetime and wartime. Like it wasn't a peacetime investment, right? It's in many ways it's a wartime investment that's required so that things don't go sideways really fast. Makes a lot of sense.
Thinking back to the financial crisis, right? Uh, Ford Motor Company was lauded as being prepared, right? They went out and restructured some finances and borrowed money at historically low rates and so forth. And they were ready for the financial crisis, actually, compared to the other automakers, right? They were in much, much better shape. When I think about this time where we have historically low rates, you can borrow money for next to nothing, especially if you are the federal government, right? Most businesses, if they knew they could go out and borrow somebody else's money at a very, very low rate and then invest it in the future, whether that's building new factories or R&D or whatever that is, you would think that was a smart business move. And so sometimes we like to think of the government as a business, and that has a lot of landmines in there. We should always be careful thinking of the government as it should operate like a business. But from that type of perspective, like, hey, listen, we had, as you said, this massive disaster, 800,000 Americans died, and the number continues to go up. We have massive economic shocks. Isn't this the time to borrow the money to invest to not only stabilize a disaster, but set ourselves up to come out of this thing much faster? Because it is going to take a while to recover.
Mm-hmm. Yeah, I look at it this way. Inflation last month was running at 6.8%. Well, that's not going to continue. And if you look at, the Treasury inflation protected securities, the TIPS, that are tied to CPI. Right now, 10-year regular bond is 1.6%. That's your interest for 10 years. And inflation, if I remember correctly, I haven't looked at it lately, but let's say over the next 10 years, it's assumed to be it's going to average 2.5%. We'll be low. We'll lowball it. So that means every time the government borrows money, you're paying the government 90 bips in real because you have a negative interest rate of a negative 0.9%. And why don't you borrow money then? I mean, you could lose 90 basis points on every dollar you invest and still break out even.
That's a really interesting way of looking at it. I think it's interesting. That's fascinating. And it's because we don't think about, I think the average person doesn't think of that. They just see this monster number.
Sure.
Like the government has X amount of dollars in debt, right?
Okay.
It's essentially a government arbitrage on money.
Yeah. And the government always arbitrages on money, but in a different way. But people don't understand is that as long as the rate of growth of the economy is lower than the rate of interest on government debt, which it almost always is, the government never has to pay back its debt. They'll just outgrow it.
Oh yeah. So you mean as long as the growth of the economy is higher?
Yeah, than the interest rate. John,
we don't hear. We can't hear you.
Great, super. User error here. So John, say those words again because I don't think you need to change them, but say them slowly.
Okay.
Because that's a pretty powerful point.
Okay. If historically, interest rates I'll make up numbers now. I'll just make up numbers now. Let's say that interest rates on government debt i- is 5%, and that's including inflation. Call it 2% inflation, 3% real growth. And let's say the nominal growth rate, I hate dealing with nominals, but it'll be easier for people to understand this way. Nominal growth rate is 3% inflation and 3% real growth. So the economy is growing at 6%, the government's paying 5% interest. Now, how does, I mean, we sit down, everyone thinks of it as a business, should be a business. Okay. So in our family, we sit down and we figure out how much we borrowed, how much we have to pay, how much income we have, and we cut to a number that we can afford that we can ultimately pay off our debt. What's the government's income? What is its basic asset? It's the tax base. That's the only way it makes money, taxes. And the asset is all of us workers out there and all the businesses out there that the government can tax. Well, if the whole economy is growing at 6%, that means the asset base is growing faster than the rate that it has to service its debt at. So if debt is equal to 100% of GDP,
Shit, we lost him again. Yeah, now you're back again.
Hello?
You're here.
Got me? I think I have to move my cursor around a bit or something. 100% debt, so you're paying at 5%, let's say you're paying $50 a year. But your tax base, your GDP just went up 6%. You don't even have to raise taxes. You are actually reducing your debt that way. I mean, it gets a lot more complicated, and maybe we'll do a special show on it one day. But then, because I have to start getting into primary deficits, which is the deficit excluding debt service. But as long as debt isn't much over 100% of GDP, and you're growing faster than your interest rate, your nominal growth rate of GDP is higher than the interest rate on your debt. Your debt is going to shrink as a portion of GDP. And that's all that matters. Because you don't ever repay your debt. The government just keeps rolling debt over and over and over again. Think of it this way. In the last 40, well, actually it's more than that, but let's say just in the last 40 years, we paid down debt exactly 3 years in the Clinton administration. Those were the only times we ran budget surpluses. You don't run a surplus, you can't pay down the actual level of debt, but you can shrink the debt as a portion of GDP. So think of it again as a business. What's your debt to income ratio? For the government, that's what the tax base, really, and that's GDP.
It's amazing to think about it that way. It's a great perspective. It doesn't mean that the government shouldn't pay down debt ever, but understanding that it doesn't have to makes it a policy lever rather than sort of some imperative that we need to be religious about.
Yeah, no, I mean, if going back to what Keynes actually said, as opposed to what people think the vulgar Keynesian said, which is that you should spend during bad times and save during good times. And what we do is we spend during bad times and cut taxes during good times. So we never save.
Fascinating. Another thing that we talked about when we first got together, that I'd love to switch gears to, is about the changes in the nature of work. And in particular, for most of us in the knowledge economy, financial advisors included, the way we work has changed quite a bit since the dawn of the pandemic. And in some ways it was headed there anyway, but pandemic really accelerated sort of the digitization and remote nature of work and got both advisors and clients, for our audience, comfortable with those remote interactions. And some people posit that, for that part of the economy, the nature of work has changed. And I'm curious if you could give us a little bit of context about, how big a part of the economy are we talking about, and what kind of an impact can we think about that having, on the broader economy?
Yeah, there's. I think at the end of the day, we're going to come to some sort of hybrid formula. I don't think everyone's always going to be working from home. Even within the so-called knowledge economy. When I was working at Principal, there were three of us on this one portfolio. It was a team of 6 people, and three of us all decided that we wanted to work remotely. I worked from Florida. One guy worked from Arizona, and the other guy worked from North Carolina. And we all moved there after having been in Des Moines. Well, one that says, the middle best is not going to necessarily be a big winner in this. But what you're going to find out, though, is that people don't want to have everybody working from home. For one thing, it's bad for people first joining the workforce because they don't have a mentoring experience. They don't make the contacts that they would make by meeting everybody at the office every day. So there are actual concerns about development of employees if everybody is off in their little silos working somewhere. So I think that's going to be one problem that would have to be addressed. And I think you do that by having people come in 3 days a week or 2 days a week or something like that. But the advantages of working remotely are so high that if you're in a situation where, and if we continue to be in a strong labor market, and you can negotiate how you work, you're going to want to work from home. I mean, you don't waste time commuting. You don't spend money commuting. I mean, once again, I grew up in New York. Commuting to me was hopping on a train. And when I moved to Manhattan, commuting for me was walking a couple of miles. But it's different. If you have an hour drive ahead of you. I mean, you could listen to our podcast, which would be a great use of your time. But driving is not all that productive in terms of how you work. If I'm sitting on a train, I read the New York Times before I got to the office. But the problem is that it makes your day that much longer. And people are moving towards wanting a better work-life balance. I think that's one thing a lot of people learned from COVID. Life is short. People get sick.
And when we think about the size of the economy and, what proportion of workers, do you think can realistically work remotely? I mean, certainly if I'm building a house or a bridge, I can't do that remotely. I can't serve somebody in a restaurant remotely. So it's only a proportion, and I just don't have a good concept of how big a proportion that is.
Yeah, I actually don't have the numbers off the top of my head, but it won't be. I mean, finance is a huge area of the U.S. economy, and a lot of that can be done remotely. Some of it can't, but you could say most of it could be done remotely. But once you start getting away from that and you get into other areas, I mean, an engineer could design from home just as easily as he or she could design from the office. But at the end of the day, the reasons why engineers and computer programmers and financial advisors are paid well is because of specialized skills, and not many people
So
have
we're
them.
talking about a relatively small proportion of the overall economy, certainly less than half.
Yeah.
Oh yeah.
You know,
Much less than
one
half.
thing.
I mean, let's put it this way:
One thing.
only about 36% of Americans have a
By the way,
college
when I
degree.
heard that stat, it floored me. I learned that that was like 20 years ago. Somebody told me that only about a third of Americans have a college degree. I was like, that can't be true. And then I looked at it and I thought about it. I'm like, well, yeah, but all the people I hang out with do, right? Like, so in my circle of friends who I went to college with, or grad school with, or whatever I associate with from a professional perspective, yeah, most of my neighbors all went to college, right? Just because of the nexus of who I am. But don't assume that everybody's like you, right? You think about the guy who's, whether it's pumping gas or the guy we talked about building houses, might not have a college degree.
The best story I have about that is when I was in college. I think I mentioned I went to a private liberal arts college in the Northeast, and we had lots of wealthy foreign students there also. And I was friends with this one woman from India, and we were talking, and I told her something like, back then it was even less. It was probably less than 30. And I told her, less than 30% of Americans have college degrees. And she looked at me outraged. And it's like, that's impossible. And it's why. And I go, why? Well, in India, everyone has a college degree. And I pointed out, back then, the literacy rate in India was something like 64%.
Yeah.
And she wouldn't believe me because everyone she knew had a college degree. Yeah. And it didn't matter all the poor people.
Probably
all
not college educated. Exactly. It is interesting. I think this is because we're getting close to wrapping it up here, but this is an important thing to think about as we think about the economy in general, right? Like we all tend to look at the world through our lens, and it's really important. And that's why I'm so wonderfully grateful to have you on the show, because you're allowed to look at things a little differently, right? Look at all the different pockets of the economy on a macro level and a variety of different micro levels, and help us understand things a little bit better. That not everybody experienced the pandemic the way that you did as a financial advisor, or the way that your clients did, who you serve, who maybe all in the information/knowledge economy, right? There's very different pockets and people experience the things differently. To kind of bring things home, I have one question that popped in my head that I really wanted to, run by you, because economists are scientists, right? You basically study human behavior and how it either impacts or is affected by money, right? The economy, right? So we've seen a lot of interesting human behavior since March 11th, 2020. I looked it up today. When was this officially considered the pandemic? March 11th, 2020, the CDC declared it. As you reflect back on this time so far, what you've observed, what are you looking forward to studying as a scientist? What's the thing you're most looking for? Like, okay, once the book is closed on this pandemic, I want to dig in on this stuff and learn a little bit, like what happened.
God. Honestly, I think the most interesting aspect probably comes from the political science side rather than the economic side. I mean, what's interesting is how did we ever, from the economic side, and it gets back into the politics here, how did we ever get to the point where we were able to aggressively use both monetary and fiscal policy at the same time? Because we have not been able to do that since the Great Depression, basically. And for one reason or another. The other question has to be how the polarization of the country affected regions and how they responded to COVID, and ultimately looking at what were the best responses and who managed to keep the economy, don't want to say unharmed, but who managed to protect the economy more from the negative outcomes.
That's fascinating. I can't wait to, I hate to say, it sounds morbid, like I can't wait to study what happened during this monument, but it is true. Like you're living through a hopefully once in a century time, right, in your life. So you're this major economic shock event has happened, and we've lived through quite a few of them in our lifetimes. But this is a monster one. It's a global economic, and we had a guest on last year or so who said, like, this is going to be the one thing that we all have in common for the rest of our lives. Will everybody live through COVID? So there'll be one thing you have in common with all the people you meet for the most part. And so it'd be really interesting to study and read about this time, like what happened and how did it affect a variety of different things. Well, Mr. Merante, I am so grateful you came on the show. Really appreciate you making us smarter, helping us understand this a little bit better. I'm sure folks are going to want to follow up with you. I know you're on LinkedIn. We'll make sure we get that linked up in the show notes so people can reach out to you. Where else do you hang out online, and what's the best way for people to find you, your writings, your musings?
LinkedIn is probably the best. I hang out on Twitter, but since people may notice, I sometimes say things that are somewhat controversial. The account I use the most is anonymous, and I'd like to keep it that way.
Okay, that's right.
But I do have a Twitter account in my name.
Cool. Well, we'll get that one linked up, but the LinkedIn will be the primary one. Well, thank you very much. It was wonderful to see you guys. Happy New Year, everyone. Wonderful first episode of 2022. Thank you very much for listening to and/or watching this episode of the Augmented Advisor podcast. It was fantastic to have you with us. I hope you enjoyed this conversation and got as much out of it as we did. Huge thanks to John Merante from SkyView Partners for joining us as well. I love how he shared his insights and analysis. I mean, I don't know about you, but I always geek out when I hear from an economist. The US and global economies are super complex and intertwined, and it's always helpful to hear from folks like John from time to time to help make sense of it all and, of course, translate that for your clients. So really, really good stuff. Listen to this again. You're going to get some good nuggets out of it, okay? All right, as I mentioned at the top of the show, please make sure you subscribe to the podcast on your favorite podcast platform, and do us a favor. Make sure you give the Blue Leaf page on LinkedIn a follow, and follow us on Twitter as well, and give the YouTube page a subscribe as well. We share every single episode on LinkedIn and Twitter and YouTube. You're going to want to follow it. You don't want to miss any of it, and we want you as part of our community, okay? We want to hear from you and get your thoughts on all the good stuff we're sharing, okay? All right, that's it for today. Please make sure you're staying safe and be nice to each other. We'll see you next time on the Augmented Advisor Podcast. See ya. Bye.